And welcome back to This Morning, 617 on your drive into work. You know, again, I was talking about earlier this week. I said, I don't know what's going on. But lately, there is just a rash of new weaponry hitting the markets. We've talked about the mini nuke with low-yield nuclear warhead. Russia has launched their drone submarine. China, stealth bombers, hypersonic weapons being developed. Another headline today. I don't know if we're spiraling towards global war here or what's going on. I know there's a lot of geopolitical tension, but Sig Sauer, one of my favorite gun makers, I love their weaponry, just unveiled their new MPX Copperhead, which is the Army's potential next submachine gun. So there we go. I don't know. Again, I don't know what's happening here. We have military ramping up weaponry. We now have the deer zombie disease. All I'm saying is I'm ready for whatever's coming.
Got to have a copperhead to take care of all that stuff.
Apparently.
What makes this Sig Sauer particularly venomous?
It works very well. It's very lethal.
I mean, it's hard.
Well, there's a whole new generation of weaponry being developed right now, kind of the next generation warfare. Mm-hmm. It's called 4G. Which is, as we're moving in that direction, different, even down to redeveloping the ammo itself, so that it has more bang for the buck, so to speak.
No pun intended.
No pun intended. So, yeah, I don't know what's coming between that and zombie diseases. All I'm telling you is that,
I'm feeling good.
Mortgages. Earlier this week, there's a transition for you.
All you need is a pattern the size of your fist.
Exactly. Earlier this week, we interviewed Andrea Riquier. She is a journalist for MarketWatch. One of the big issues that's been going on, I've been telling you here over the last couple of months that I've sold my house and we're living in an apartment right now and getting ready to move into a new house, later on. And we're going through the mortgage process right now. And the mortgage process, because I'm a small business owner, is always very interesting. It's never cut and dried. It's fairly easy if you just got W-2 income. But because I own multiple small businesses, I have very complicated tax returns, all these K-1s. I have all this other stuff that's going on, which makes it very complicated. Of course, I also write off a lot of stuff. I take full advantage of the tax code as it's written. And so my return's always complicated, which always makes it very difficult to go through the mortgage process. And so we're going through that process right now. And, of course, this spurred the conversation we were having about what's happening with home prices around the country and, of course, with mortgages and real estate in general. We're seeing declines in real estate prices in California, New York, of course, Florida in particular, because of two things, really. There was two big changes to the housing market over the course of just the last couple of years. One of them is the fact that interest rates rose to over 3.25%, which immediately spiked up mortgage rates. And I've been saying for a while is that in an environment where people are heavily leveraged and there's very little excess capital, small changes to interest rates have a very big immediate impact on the economy. So really, we were talking about the Fed earlier. It's not surprising the Fed is pulling back on their tightening of monetary policy because it had an immediate impact. As soon as they started doing it, the economy started slowing down. We started seeing impacts to housing, auto sales, etc. Because simply people can't afford any change to their payments because there's no excess capital to deal with. Wages haven't risen to any great degree. Yes, wages are up a little bit, but wages are about the same as they were in 1998 on an inflation-adjusted basis. So you're not making any more money, but the cost of living has gone up. So it's not surprising that there is on average about a $3,000, about $3,700 to be exact, annual gap between what people bring home and what they spend every year. And this is why it winds up on credit. And we have record high credit levels right now, right? So we have record high credit card debt, record high mortgage debt, record high blah, 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 student loan debt, etc. So not surprising. So we started talking about this, and so we thought we'd explore this a bit more, and we visited with Andrea Riquier. She is a journalist for MarketWatch. Her whole specialty is national real estate, what goes on a national basis. And so we were talking a little bit about the average fixed rate mortgage size, which is about $300,000. Of course, that makes sense. The median house price across the U.S. is the high 200s. But what's interesting is the average adjustable rate mortgage. Now, that's the ARM, the adjustable rate mortgage, was $700,000. So if your mortgage is $700,000 or more, that home is presumably closer actually to $1 million because you can put some money down, right? So they don't have an ARM isn't like a Fannie Mae where you put 3% down. You have to actually put some money down on the house. So you're talking about people buying $1 million homes. Anyway, she had a very good, interesting point about this.
If you need to get an ARM to get into a home that costs close to $1 million, what is going on in the market?
Right.
I think I called it sort of an artificial way to get in with the assumption that you will refinance later.
Right.
Which, come on, everybody knows that, right? Everybody takes that for granted. But I did get some pushback on Twitter from some people in the industry, who took exception to that. But
right.
that's very much how I see that statistic.
Yeah, no, and the reason that that's an interesting statistic is because, again, if people are using an ARM to get in the mortgage, there's a couple of things that are going on. One, they don't have the ability to qualify for a fixed rate mortgage through Fannie Mae, Freddie Mac, et cetera. In other words, the maximum size jumbo loan is about $485,000, which means that instead of financing $700,000, they just put some more cash down on the house and they just finance a jumbo through Fannie Mae or Freddie Mac. So, it all comes back to this idea that because of low interest rates, we are able to buy more house. This is why, this whole idea about low interest rates in the economy is not always a good thing. Low interest rates in an economy are a good thing to a point, but what has also happened with housing, which is one of the largest chunks of our monthly budget. I mean, ask anybody, right? You say, what's your biggest expense every month? Outside of healthcare, it's probably your house. And so, and next beyond that is paying for kids. And after that, if there's anything left over, you might be able to afford a beer. So there you go. But yeah, so for most people, this is kind of how it works. And when you have ultra low interest rates, what happened, and this is one of the big issues that led up to the financial crisis in 2008. We had all these exotic mortgages, and because of low interest rates, people would go out and say, okay, well, my budget says I can afford, a $150,000 house. Well, because of low interest rates, I could actually afford the same payment and buy a $200,000 house or $250,000 house. And so, of course, what happened is that, again, the demand for higher quality homes expanded because of low interest rates. If interest rates are at 6%, I can afford this value of a house, but at 4%, I can afford a whole lot more house. And of course, real estate agents are complicit in this as well, because you go to them and say, look, I'm looking for about a $250,000 house or a $100,000 house or $150,000, whatever it is. Well, the first house they show you is like a $350,000 house, and it's got all the bells and whistles. It's everything you'd want in your house. And so then they go, okay, well, let's go look at the house in your budget. I just wanted to show you this. I thought it was a pretty house. I thought you'd like it. Let's go look at this other house. Well, you walk into the house that's in your price range, and all of a sudden it's like, man, this looks terrible. So she goes, well, I can get you in that other house. We can do an adjustable rate mortgage. We can do this type of mortgage. We can do that. We can put, we can shift it. We can do a split mortgage. We can do 80-20. We can do all these, all these machinations to get you into a house you really can't afford. And so we did that. Well, of course, home builders, happy to comply with that, built higher quality homes, right? So they built higher end homes, higher value homes. And so that's caused the price value of the median home price to increase over time. And unfortunately, it's now getting to the point that has now become unaffordable for many Americans. They can't qualify for the mortgage because we've tightened up our lending standards. Incomes and debt levels haven't adjusted enough to allow for people to afford higher homes. And so again, when interest rates even rise just marginally, you have a very big impact to the housing market across the board. And we've seen that. So when we start talking about watching these financial hardships, et cetera, for people, also remember that, as we've talked about before, the people that are buying homes now, right? We talk about the millennials. They're not buying houses. They're wanting to rent more. Well, you got to remember, these people watched their parents go through losing their houses in 2008. And Andrea had a really interesting point about this, about potential home buyers not willing to take that plunge into home ownership. Cut 32.
As somebody who straddles the Gen X millennial divide, I'm going to make a plug for Gen Xers as the people who got screwed the most. I closed.
She gets a blue ribbon.
Right. I closed on my first home, and like 2 months later, Lehman Brothers went kaput.
Wow.
And that was a really scary time for me. I got lucky, but a lot of Gen Xers lost a lot of equity.
Yeah.
But yeah, I mean, millennials, to your point, millennials saw what happened. That said, there's still this really intrinsic, strong American desire to own a little plot of something, right? So I don't know. I think maybe some of that will work its way out.
That entire interview is being released at 11 o'clock today. So if you go by our YouTube channel, The Lance Roberts Show, go to YouTube/Lance Roberts Show. You can subscribe there, by the way. Click the subscribe button, and we will email you all of our podcasts that we deliver every week. We do about 2 a week on special topics. We have interviews with some of the top minds in the country on finance and economics, markets, what's going on. So we get those to you via our direct link through YouTube. But also, you can also pick up all of our podcasts and our radio show every day at our website. Simply go by LanceRobertsShow.com or RealInvestmentAdvice.com. Either one will get you the same place. Click on the podcast tab. You get all of our podcasts, interviews, radio programs, more. It's all there for you. We're going to be right back after the break. But again, grab that interview today. It's the podcast with Andrea Riquier at 11 o'clock. It'll be released. And you, again, find that on both our website and our YouTube channel, The Lance Roberts Show. We'll be right back after the break.
Get daily investment news you can use, delivered at the speed of the internet. Sign up for Lance's newsletter now at LanceRobertsShow.com.